Most investors spend their time looking for the next great stock, the next hot sector, the next signal that tells them when to buy and when to sell. And most investors underperform a basic index fund, not because they picked the wrong stocks, because they were optimizing for the wrong thing. The single highest return investment you will ever make is not in the market. It is in the 15 minutes you spend every morning before you touch it. This is about that 15 minutes and what it compounds into over time. There is a habit shared by some of the most successful long-term investors in history, and it is almost embarrassingly simple. They read every single day, deliberately, with intention. Not headlines, not social media, not the opinion of whoever is loudest that morning. They read deeply. Annual reports, economic history, biographies of business builders, first principles thinking about how industries evolve and die and are reborn. This is about what 15 focused minutes every morning, compounded daily over months and years, actually builds inside you, and how that invisible structure changes the quality of every investment decision you make. An investment in knowledge pays the best interest. Benjamin Franklin wrote that 250 years ago. The research now proves why. Let us be honest about what most people actually do before they invest. They check the news. They scroll the finance feeds. They hear someone mention a ticker and they feel the pull of FOMO. They make a decision under the influence of whatever was loudest that morning. The research is devastating. The average equity investor has consistently underperformed the S&P 500 by 3 to 5 percentage points annually for over 3 decades. Not because the market is rigged, because of behavior. Loss aversion. We feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. So we sell when we should hold. We panic when the market drops, locking in losses at exactly the wrong moment. Recency bias. We assume that whatever just happened will keep happening. Markets rise and we extrapolate euphoria. Markets fall and we project catastrophe. We are perpetually fighting the last war. These are not flaws of intelligence. They are features of the human brain evolved for survival, not for long-term capital allocation. And you cannot think your way out of them in the moment. You can only build the cognitive framework that makes better decisions automatic before the moment arrives. That is exactly what the daily habit does. Here is what actually happens when you build a consistent daily reading and reflection habit. In the beginning, almost nothing. You read a chapter on behavioral economics and feel slightly smarter. You understand a concept at a level slightly deeper than before. This is not impressive, not yet. Each piece of knowledge you add is a new thread. On its own, almost nothing. But over months, those threads begin to connect. Patterns that were invisible become visible. A business you are evaluating reminds you of a case study you read 6 months ago. A market behavior triggers a memory from economic history. Neuroscientists call this associative memory consolidation, the brain's ability to link disparate pieces of information into a coherent framework that operates almost intuitively. The more threads you lay down, the richer the fabric. And the richer the fabric, the more clearly you can see what others cannot. Naval Ravikant describes reading as compressing the life experience of the smartest people who ever lived into your own mind. 15 minutes a day is not just reading. It is downloading mental models from across centuries of human experience and hardwiring them into your decision-making. Research published in leading neuroscience journals found that people who regularly engaged in deep reading showed measurably stronger neural connectivity in regions associated with reasoning, empathy, and long-term planning, the exact cognitive functions that drive superior investment judgment. So what does this actually look like in practice? Because 15 minutes is not a lot. Used well, it is more than enough. Here are the 4 layers of the daily habit, and the specific return each one compounds over time. Layer 1, 5 minutes of first principles reading. Not news, not commentary, source material. A page of an annual report. A chapter of economic history. A paragraph from any thinker who built real insight from first principles. The goal is not to finish anything. It is to add one thread to the lattice, every day, without exception. The compounding comes from consistency, not volume. Layer 2. 5 minutes on one honest question. Not, should I buy this? That is noise. A real question. Does this business have a durable moat? Or am I assuming permanence where there is actually fragility? Am I holding this because it still makes sense, or because I am emotionally anchored to what I paid? One question, sat with real honesty, is worth more than an hour of chart analysis. Layer 3. 3 minutes. Write it down. One sentence. The thought you just had. The question you asked. This creates an external memory the market cannot distort. When you are panicking in a downturn, you will have written proof of what you believed when your mind was calm. Revisit it quarterly. Your biggest protection against recency bias is a written record of your own past thinking. Layer 4. 2 minutes. Set the emotional frame. Silence. No phone, no market open. A quiet acknowledgement of what you know, what you do not know, and what you are going to let the market decide without interference today. This is not wellness. It is cognitive hygiene before operating in an environment specifically designed to trigger your worst impulses. 15 minutes, 4 layers, every morning. Compounded over a year, you have read the equivalent of 12 substantial books. You have asked 365 real questions about your investments. You have 365 written records of your reasoning. And you have built a daily ritual of emotional regulation before one of the most emotionally demanding activities a person can engage in. Let us be precise about the claim in the title. If the average retail investor underperforms the market by 4% annually due to behavioral errors, and the research consistently shows this, then eliminating even half of those errors is worth 2% of additional annual return. 2% compounded over 30 years nearly doubles a portfolio from simply making fewer mistakes. But the deeper return on this habit is not measurable in percentage points. It is the quality of conviction that builds when you have genuinely done the work. The ability to hold a position through volatility because you understand why you own it, not just what you paid for it. The confidence to act decisively when others are paralyzed by fear. That is the real 10 times. Not just financial, cognitive. The stock market is a device for transferring money from the impatient to the patient. Patience is not a personality trait, it is a skill. And like every skill, it is built through practice, daily, deliberately, before the pressure arrives. Tomorrow morning, before you check your portfolio, before you open the news feed, before the market opens and the noise begins, try this. 5 minutes on one real idea. One honest question about something you own. One sentence written down. 2 minutes of quiet before you engage. That is it. 15 minutes. It will feel like almost nothing. Do it for 90 days and look at the quality of your thinking. Look at the calmness of your decisions. Look at what you have written. And notice how much clearer your reasoning has become simply because you made it visible. The best investors in the world are not the ones with the most information. They are the ones who have built the best relationship with their own mind. That relationship is built one morning at a time. If this gave you one idea worth keeping, one shift in how you think about your money and your mind, then we would love to have you subscribe. Every week on this channel, we explore the habits, the psychology, and the mental frameworks that separate the investors who build lasting wealth from those who are always chasing it. It would mean a lot to keep building this with you. I will see you in the next one.